Welcome to the Long-Term Investor. Today, I have the pleasure of being joined by Dr. Nicole Boyson. Dr. Boyson has been at Northeastern University since 2004, where she teaches and conducts research in areas of investments and corporate finance. Nicole is joining us today primarily to talk about her research on financial advisors and potential conflicts of interest. But before we go there, Nicole, thank you so much for joining me here today.
I am very happy to be here.
You actually have some industry experience, but you also have quite a wide range of research. Maybe you could tell us how you came to focus your research on the financial advisor space and elsewhere holistically.
Yeah, absolutely. So when I was starting graduate school, it was 1998. And so, long-term capital management was blowing up. And I thought, hedge funds, super interesting area to do work in. And so I spent, a good chunk of my career and still working in the hedge fund space a little bit. Started out focusing on aspects of risk and return and manager skill, and then moved into the activism space. And I think hedge fund activism is just fascinating, partly because it's these great stories of these big personalities coming in and just making a big fuss. And so it's just interesting to read the stories, but also to think about, owning a small stake in a company. Can you make a big difference? And so that was super fun area to work in. Along the way, I did a little bit of work in commercial banks. Financial crisis got me interested in that. And I also had previously worked at a commercial bank. So I had some sense of the way that banks ran. In particular, the bank I worked at was a modest size savings and loan, which has a very different objective and perspective than a larger investment combo commercial bank. And so some of the work in that space I did was looking at sort of arbitrage opportunities in that space and recognizing that people didn't really understand that not all banks operate the same way. And so that was really fun. And then, for a little while I worked in my industry life, I worked for an investment advisor. He was a kind of a smaller broker. He sold mutual funds, lots of load shares to his clients. And then he also had a pension business on the side. So sort of double business. He also was an RIA. And so he had some separately managed accounts. And so just learning about that business, the first thing I really learned about was how complicated mutual funds are in the way that their pricing structure is incredibly opaque and confusing, and investors have trouble understanding it. So I thought that was interesting. And I'll also say that I'm not certain that he was always as ethical as he could have been in the way that he described the investments he was putting his clients in. And so, that was the back of my mind. 1996, I worked for him. And then fast forward, and I also done a little bit of research in the mutual fund space. And I've always been interested in the idea of, why do people use financial advisors? And in my mind, financial advisors were mostly kind of brokers, right? That's how I thought of it, because that was my business. And so as I started learning more and reading more, there was this great graph put out by the Investment Company Institute, ICI. They do this great annual report on mutual funds. And I saw this picture, and it was so compelling. It's now in my paper of some version of it. But effectively what I saw was that money was flowing into institutional share classes of mutual funds and flowing out of the broker sold classes. And having worked for a broker who I didn't necessarily think was the most ethical person in town, I thought, well, this is great news, right? Money's going away from some of the broker sold, which are opaque and complicated, and into investment advisory, which are going to be, charging a fee, but the funds themselves don't have as many embedded commissions or fees, or so I thought. And so once I started digging into that, I realized, oh my goodness, it's much more complicated than I thought. There are fiduciaries, there are non-fiduciaries, there are dual registrants, and it's a little bit of the Wild West out there. And so my initial interest was somewhat personal, having worked in the space, driven by my hope that, oh gosh, more investors are educated and using registered investment advisors who are fiduciaries. And then I realized it's some kind of weird mix of the two. And so there began kind of my foray into becoming an expert on what it means to be a fiduciary and really trying to think about investment advisors and how they treat their clients and, whether they're acting in a way that really serves their clients well.
When you ultimately wrote a really nice paper called The Worst of Both Worlds, and you also, for all those people who don't like reading academic research, put it out in plain English on your Twitter account. And I'll certainly be sure to embed that Twitter thread in the show notes at thelongterminvestor.com. And I was hoping maybe you could discuss some of the types of conflicts that you examined.
Yeah, sure. And yeah, I was in an airport when I put that Twitter thread out because I was presenting the paper at a conference, and I thought, you know what, I have some time. I'm working through my slides. Why don't I kind of mini present it to my Twitter friends? And so it's my pinned tweet now. And it is, thank you. It is, I think, does explain things pretty clearly. That's one of my goals as an academic, is to not be too esoteric. But yeah, so really what the conflicts that I see, very interesting. So dual registered advisors are, you know, what it sounds like, registered both as brokers, which again are not necessarily the bad guys, and both as investment advisors, which registered advisors, which not necessarily the good guys. But the majority of advisors out there, something like 80+% of assets are overseen by these these advisors that wear both hats. And so if I'm working with a client and I have my broker hat on, I'm allowed to charge commissions. I don't need to act as a fiduciary, although Reg BI has brought that a little bit closer. And if I've got my RIA hat on, I'm required to act as a fiduciary. Duty of care, duty of loyalty, put my client's interest first. And so the interesting thing to me is that can be the same person in the same firm, right, serving different clients. Even the same client could have a brokerage account with me as a dual-headed RIA. I'm not, but if I were, and an RIA account. And so I just thought that was fascinating. And it seemed to me that within a company that allows that, there has to be, right, there is not a perfect wall between them, particularly because it's often the same person. And so what I thought about was, what specific conflicts are going to arise from the dual registration? So we know that brokers have conflicts, and we know that independent RIAs have conflicts. Everyone has some conflicts. It's how you manage them, disclose them, and deal with them. But as a dual registrant, you have some very specific conflicts that can't exist if you're an independent advisor. And so here's one of them. One of them is that if you are a dual registrant, that means you have a brokerage arm to your business, which means that you can sell a mutual fund share class that has an embedded commission called a 12B1 fee, and you have a mechanism by which to collect that commission. And so I can be a registered investment advisor, charging my clients however I choose to, big debate over that, but say I charge them a percentage of assets, and that comes to me separately, right? And they can see that on their account. I can also charge them a 12B1 fee through the mutual fund that I choose, and that's going to be much more opaque. And so one conflict of interest is being able to double charge an advisory fee and a commission. Now, the 12B1 fees that most RIA dual registrants charge is 25 basis points. So one might argue it's not huge, but it's pretty big, and the dollars can add up. So that's one type of conflict. Another is what's called revenue sharing, which is, again, the word revenue sharing oftentimes is very broad, and it might mean like it might incorporate that 12B1 fee. But what I'm speaking of when I talk about revenue sharing is a check that a mutual fund family will write to the dual registered firm. So kind of Ameriprise. So say, you know, I am MFS and I am running a big mutual fund company, and I want Ameriprise, both their brokers and their RIAs, to use my funds. And I've got funds that are appropriate for brokers that have a load, and appropriate for RIAs that maybe have a 12B1 fee, maybe don't, but are paying a smaller commission, if any. And so MFS says, all right, you know, Ameriprise, tell me the total dollar business that you gave to MFS this year, right? They can look that up. And they'll say, we'll pay you a chunk of change from the fund family, from MFS, so not coming from the individual funds, and we write that check to Ameriprise every year. That's called revenue sharing. It's not off the books in the sense that it comes from MFS's profits, but it's off the fund books, right? It's not coming directly out of each fund. It's incredibly hard to track. No one knows exactly what the dollar amount is because it's not disclosed anywhere. Neither is it disclosed. It's not disclosed in the RIA's Form ADV. It's not disclosed anywhere by FINRA. And the mutual fund family will just say, hey, we sometimes pay revenue sharing. Go ask your RIA. The RIA will say, we take revenue sharing. Go look at the prospectus, right? So there's this circular kind of path, but revenue sharing is substantial. I can't get precise dollars, but I can sometimes get dollars, and it's certainly in the tens to 20s of millions of dollars per year that, say, Ameriprise is receiving from a bunch of fund families. So this is in addition to any commissions. Couple things. One, the advisors don't get that check, right? So if I sell a mutual fund that has revenue sharing, I'm not getting a bigger bonus. But what does happen is that obviously the revenues of my firm increase. So that's one. So that's good news for, say, Ameriprise. The second is that Ameriprise, in exchange for the revenue sharing check, will very strongly and explicitly put my fund family prominently on their preferred list of funds. So when they hand out that list of funds, whether it's to the RIAs or the brokers, MFS is sitting there on the top of it. Third, MFS now has access to the advisors. So they'll come and do education and sales seminars. Maybe they'll be somewhere swanky. You can guarantee there's hats and there's vests and there's all kinds of great swag laying around from MFS. So I walk into a firm. I'm 22 years old. I'm a newly minted RIA and broker. And my boss says to me, hey, you know what? We offer like 4,000 different mutual funds, but here's our favorite ones. And it's going to have 20 funds on there. They all revenue share. That's the preferred list. And I can promise you as a 22-year-old, that's probably the list I'm going to go from. And so the conflict is very clear to use the MFS funds. And again, I'm picking on them. All the big load fund families revenue share. But those funds then are going to be prominent and popular. And revenue sharing is something that the client ultimately really doesn't know about. It might show up in the form ADV as a we revenue share, but you have no idea the dollars, the relationships, and so forth. And so that's a second type of conflict that's very clearly only available to a dual registered advisor. Because again, the revenue sharing comes through the brokerage side of the business, but it's applied to all the assets in the business, the RIA assets and the broker-dealer assets.
Well, and because you said, hey, we're just picking on Ameriprise, I'm actually pulling up your Twitter thread right now to see the top 10 dual registrants of 2016, just to give people some of a sense of some of the names here that pop up. You see Goldman Sachs, Northern Trust, Merrill Lynch, Morgan Stanley, UBS, Wells Fargo, Ameriprise, Raymond James, Edward Jones, Lazard Asset Management, all really household names. And what's interesting to me is sort of the way that we got to this environment that even allows for this in the first place. I graduated college in 2007 and started working for an independent RIA right out of school the summer of 2007, right before the financial crisis. So that was fun, yes. But I don't think at the time when I joined that firm that I really understood some of these kind of key regulatory developments. Can you sort of walk us through those timelines on how we got to where we are that even allows these dual registrants?
Yeah, it's really interesting. So I have a bunch of detail in this paper. And one of the things I love about being an academic is all the institutional detail. Sometimes I think I could have studied law because it's fascinating to me. But back in 1990, so go way back, Merrill Lynch started charging asset-based fees in their brokerage accounts. So again, a lot of firms were dual registered back then, but something like 90% of their business came from the brokerage side and a very modest amount coming from the RIA side. So they were born and bred in the brokerage space. And remember back then, you're selling individual stocks and collecting commissions of a couple $100s per trade, right? So it was very lucrative to be a broker, and you had a lot of incentive to be, that guy on the phone in every movie, buy, sell, Wall Street, whatever. So there was a huge chunk of that happening. So Merrill Lynch had a bunch of clients who were like super traders, right? They wanted to trade all the time. And they decided, and this actually probably wasn't terrible for their clients, to say, you know what, we're just going to charge you a fixed fee. We're going to charge you 1.5% of assets or whatever it is. And you trade all you want. We'll cover all your costs, right? So these were called wrap accounts, a term that's also used kind of all over the place to mean a bunch of things. But this was really popular. So in 1990, Merrill started doing this. And they got special permission from the SEC to do this. And I forget the name of it. It's in my slides, but something like firms deemed not to be investment advisors or something crazy. And so this rule came into place. So Merrill started doing this. A bunch of other folks started doing it as well. And they realized quickly that an annuity, right? Not a variable annuity, but an annuity in fees coming every year is kind of nice, right? I don't have to call the guy every day. I'm just charging him a fixed fee and we're going to trade and that's the place. And so it was a big deal, but a lot of firms were doing it. They got an SEC no action letter. And this was all going on for a decade and a half. Finally, in 2004, the Financial Planning Association, who represents independent advisors, sort of saw this happening, and they said, rightly, this blurs the line between registered investment advisors and the brokerage side of the business. And again, this was all happening in the brokerage side of the business. They were dual registered, a lot of them, but they didn't have very big RIA businesses. And so, all these RIAs who were independent were annoyed that this was happening because there's no sort of regulatory language around it. You can call yourself an advisor and no one knows how you're spelling it. And it's this whole thing, right? So you're working out there, you're an advisor, you're basically a broker, which again is fine. But the way the fees were being charged made you look like you might be a fiduciary. And again, we don't think for a second that the firms were sad about that, right? It sort of gave them some credit. So the Financial Planning Association, FPA, sued and ended up winning in 2007, winning the lawsuit. And the lawsuit effectively said, you shouldn't be able to charge asset-based fees in brokerage accounts. And so the SEC lost this case, right? They lost the case. And what happened was the rule then was, well, if you're going to charge asset-based fees in an account, you need to be an RIA account. It needs to be a fiduciary. It doesn't have to be independent, but it needs to be a fiduciary, SEC-approved fiduciary account. And so the independent advisors sort of thought this was a victory because, oh boy, now, these folks are going to have to start acting like fiduciaries. But really, all that happened was Joe was in a brokerage account on Saturday, and then the rule came down, and on Monday, he was in an RIA account. I didn't change anything about his account. Over time, what happened then was, starting in 2007, you can see it really dramatically in my paper, there was a huge shift within the dual registrants. First of all, those that weren't dual registered went out and quickly got dual registered. And second, those who had sort of dormant RIA businesses immediately switched clients over. So it was something like a couple $100 million got switched over in the first couple of weeks. And as time passed, the RIA side of that business, revenue-wise, grew substantially. The whole thing grew, but the percentage of the RIA piece got much larger. And now it's more than 50%. So firms like Merrill and Ameriprise and so forth, they have both sides of the business. They focus very strongly on the RIA side because, again, it's nice to have that annuity. And frankly, I was thinking of this today. I think I'm very clever, but I thought, they talk about, Rhino, Republicans in name only. People like to give them a hard time or whatever. I thought, well, there's also this FINO, right? Fiduciaries in names only. So you heard it here. It's now trademarked. But I think a lot about, they're following the rule of the law, the letter of the law. But, my paper concludes that they're not often following the spirit of the law. And so this is what happened. There was this big shift. It looked like a big win. And all these firms just laughed and said, haha, now we're just going to become fiduciaries. The hurdle really isn't that, at least on paper. And that's how we're going to run our businesses.
Well, it's so interesting the way that all developed because as I mentioned, as I started my career in 2007, I remember that our primary sales pitch, for lack of a better word, to people with a broker is, hey, you have a broker, you should be choosing someone who's independent and can use any investment product that they want and has a fee structure that is more closely aligned with your interests so that you can be sitting on the same side of the table. And also is sort of at a period of time where either there was more evidence or more awareness of evidence and that active managers tend to trail passive managers. And that's maybe something that academia has known for a very long time. But
since I was born, 1968 was the first paper. So.
Is that right? I didn't know that.
Yes.
And I know S&P does that, index versus active scorecard, and that became more publicized. Yeah. And I think that was a big debate once upon a time, and that's something you don't hear a debate about. But those two things, the rule in which you need to be an RIA and act as a fiduciary versus plus the fact that people are starting to discover, hey, traditional active managers that my advisor is putting me into have historically not done that well. You would have thought there would have been a bigger push. And fast forward to now, people are looking for an advisor. They don't always really know whether their advisor is registered one way or another. So for those of the listeners who either have an advisor or considering looking for an advisor, what are some of the things they can look for to better unearth some of these conflicts?
It's a great question. And so one of the things I love about being an academic is, I'm truly independent. I just call it like I see it, right? And so I won't recommend any individual advisors because that's not my job. But what you can do is, yes, so I sympathize with that. I can say that it took me about 6 months starting this paper to really understand the difference. And I would get so frustrated because I would read an article and it would be written in popular press and it would just say advisors. And every time I'd be like, fiduciary or not fiduciary, please help me understand this. And I had fights with people in industry who told me that fiduciary advisors couldn't accept 12B1 fees or revenue sharing. And I was like, that's just not true, right? So some of these people were fiduciaries, some of these people were dual RAs, right? So super confusing. But a couple places to go. So the first is to find your advisor. So there's sort of two places for that. The first is FINRA's website, and we'll get the links, tied into your thing. It's called Broker Check, and you can look this person up, and it will give you some basic info about them, particularly things like how long they've been in business, disciplinary history, and so forth. And then the SEC has a website, Investment Advisor Public Disclosure, IAPD. That website is great because it will give you the form ADV, which I'll talk about in a sec. You can get the form ADV and the form ADV Part 2, also known as the brochure, but you can get that info about the firm and or the advisor. So you can search IAPD individually for advisors and firms. You probably want to search, in my view, the easiest thing is to search that for the firm. You can find, the name of their company, and then it will tell you more pretty clearly in the front of the page, this is a dual registrant. There's also a new form called Form CRS that you'll find in the IAPD database. And that form at the very top has to tell you whether your advisor is dual registered. So Form CRS, Form ADV, both of those are the SEC's IAPD. And then FINRA Broker Check, super useful. So my brother had called me, a couple years ago and said, hey, there's this guy, he's thinking about using him for his business. My brother runs an assisted living facility. And he said, I like this guy's really nice, came in, he's, we might use him for our business. He said, I might even use him for my own stuff. I said, all right, Boyson, let me go look this up. And I looked the guy up and, a year ago, he got busted for stealing money from old people. This is not good, right? So you can it took me 2 seconds, it was free. And I said to my brother, this guy's shady, please don't use him. My brother's a smart guy, he's a finance guy, but he didn't know to go look. So go look the individual up on FINRA, certainly look up the firm on the IAPD. I also want to make it very clear that the very nature of being a dual registrant does not mean you're an evil empire person. Most of the individuals in the space are decent people. A lot of them work for firms that are very conflicted. And so the conflict level starts at the firm level. Now, many of those advisors, frankly, might not even really know the difference between the RIA side of the business and the brokerage side. Despite taking some exams, the exams are pretty short. You might cram for them and then forget. But it's really important to sort of understand that. And I think there's better education going on inside the dual registrants. But what I can say with some certainty is that dual registered firms have greater conflicts than independent firms. An independent firm may still be conflicted and certainly may overcharge you, right? This is a separate question. But a dual registered firm almost for certain has the ability, again, to receive 12B1 fees, to receive revenue sharing, and to recommend mutual funds from the brokerage side of the business into the advisory side of the business. And in many cases, I found in my work, one, there was less due diligence on a lot of those firms, right? So I've been using MFS forever and I'm buddies with the wholesaler. I have a friend who's a wholesaler for MFS, so I always think of her because we laugh about this. She's great, but this is the game you play. And the other piece of it is that despite sort of that, it's a big firm and it's, it's recognized and it's a good firm, MFS or whatever. What I find in my paper is that the funds that are most likely to be engaged in revenue sharing and paying extra fees to these dual registrants tend to underperform. Now, that's not a super new finding. The reason is that these are funds that are the load mutual fund families, and other literature finds the same thing. And so my connection here is saying, look, these fund families, they have a captive sales force within the dual RIA space. So one of my explanations for this finding is that it's not hard to sell these funds, right? These funds are sold, not bought. And as you mentioned, I'm looking at the active funds. So I'm comparing active funds that are sold primarily through this channel tend to underperform active funds that are not sold through this channel. So if you think really loosely, kind of load fund families versus no load fund families, but that's not a perfect comparison because now the load fund families also sell different share classes that don't have commissions. And so, but that's their bread and butter. That's where they came from. So this isn't an active versus passive. This is an active load fund versus active non-load fund. We still see better performance in the no load. And I think a lot of it has to do with with how they're sold.
Well, that's really helpful and a good explanation. Lots of links that I'll be sure to put in the show notes at thelongterminvestor.com. And also for listeners interested in this topic, there are two episodes I can refer you to. Episode 26, which is Not All Financial Advisors Are Created Equal, as well as episode 28, How to Interview an Advisor. And one of the things that came out in the past few years, Nicole, is Regulation BI. And people at PlanCorp who are more in the weeds than I am about this stuff sort of classified it as toothless. Would love to get your opinion, maybe explain a little of what Regulation BI is and how you feel it does or does not address some of these issues.
Yes. So Regulation BI was a bit of a response to some protest across the board from whether it's clients or industry participants that the brokerage side of the business, and Regulation BI focuses largely on the brokerage side of the business, although there is some piece of it related to RIAs, that there were some practices happening in that space that just were really not good for clients. So interestingly, if you're a broker, right, you have the broker hat on, you're not required to be a fiduciary. And the term fiduciary includes the term best interest. So you can also see how kind of confusing this is. The regulation's called Regulation Best Interest. It governs largely the brokerage side of the business, yet it stops short of making brokers be fiduciaries. The old rule for brokers was the following. It said, if you put a client in an investment, it has to be suitable for them. And the suitability standard was below the fiduciary standard. The suitability standard, in a really simple way, effectively said, you can't put a client in some sort of investment product that's completely inappropriate for them, whether it has to do with risk or cost or sort of expected returns. And so suitability was this sort of bare bones minimum of, don't put your 95-year-old client in some inverse exchange triple floater thing, right? You don't want to put him in something super ridiculously risky. But it's sort of that was the big piece of it. And the idea of the suitability standard was kind of supplanted by Regulation BI, which adopts some kind of fiduciary roles, but not others. The other thing Reg BI did, two other things that I think are relevant. One is that it took away a few really unsavory brokerage practices. Like some brokerage firms had sales contests, who can sell the most of XYZ product. And XYZ product would usually be super expensive, super big commissions. And you can see how that would be a really obvious and overt conflict that was stopped by Reg BI. The second was this Form CRS, and Form CRS, Customer Relationships Summary, is supposed to give a potential customer of your firm, info about your firm and what you do. And so it has to be short. It's like 2 pages if you're not dual registered and 4 pages if you are. And it has a very sort of theoretically a very structured format, which says, I'm an RIA. In this case, I'm not an RIA. In this case, our firm does both. Here are some of the potential conflicts. But as you might expect, 2 pages is ridiculously short. Most of these firms have 95-page Form ADVs plus other stuff. And so what ended up happening is sort of I and Jason Zweig from WSJ, we joke about this. I said, Jason, here's what this thing's going to look like. It's going to be 700 hyperlinks to web pages that are 50 pages long. And sure enough, that's what these things look like, because you can't get it in 2 pages, right? And you're supposed to give fair, disclosure on fees, and every firm just punts on that. Our fees are complicated. We charge different fees to different people. Go read this thing. And so it turned out that Form CRS, I still think there's a little value in it. You can at least see, is this advisor dual registered? You can maybe ask about that. But otherwise, it's just a lot of hyperlinks that are already out there somewhere. And my favorite hyperlinks are the ones to just the webpage, www.ameritrade.com. Like, good luck, right? So that's sort of, not Ameritrade, I'm sorry, Ameriprise. Ameritrade's fine. Ameriprise.com. So that's sort of a little bit problematic. Reg BI is hundreds and hundreds of pages long. I agree. It has very little teeth. It doesn't change much. It does not help clear up the difference between RIAs and brokers, and it certainly does not make brokers adhere to a much different standard. And again, that said, many brokers are perfectly good in adhering to reasonable standards, but it didn't change much. One reason, huge lobbying groups in that space. And the second reason is really, once you start charging a percentage of assets, you're butting up against that rule, right? And so the way that fees are charged it's so weird to me. But Michael Kitces hit it on the head when he wrote about this, I don't know, probably 10 years ago. And he said, look, the way that fees are charged is the way that we differentiate between brokers and investment advisors. It has sort of, in practice, that's how I can tell. Like, if I don't know if my guy's a broker or an advisor, I go look at my statement. If I'm getting charged percentage of assets, it must be a fiduciary advisor. That is really terrible, right? That is a terrible way to figure out if I'm being treated, as a fiduciary client.
It does seem like it ought to be far more clear as when I go to the doctor and the doctor prescribes me something that I'm assuming that prescription is in my best interest. I'm not thinking that the doctor is writing me a script for something because they got a round of golf out of it or something like that. Although I know those sort of incentives in medicine have shrunk dramatically in the past few decades. Regardless,
but they still exist, right?
Yeah. Well, and so I guess I don't think a ton has changed in the current landscape since you've written this paper. But I'd be curious if you could design policy to sort of mitigate these conflicts, what that might look like. And maybe even as you're pointing out things to help mitigate, maybe you can give examples of how the current status sort of plays out and hurts the end investor.
Those are great questions. And interestingly, the SEC kind of came across a way to help mitigate that I think was intentional at the time. So in 2019, they had what's called the Share Class Disclosure Initiative. And they went to dual registrants because, again, they're the only ones that were affected by this. And they said, look, if you're selling your clients mutual funds that have these embedded 12b1 fees, which are commissions, you need to disclose it better to your clients. And they said, we know you're not, right? Like, we know. And the SEC is woefully understaffed and so forth. But they said, we know you're doing this. So here's what we're going to do. You come to us and tell us that you're doing this. And we will make you pay back any excess fees that, you should have paid back, that you shouldn't have collected in the first place, but we won't charge you a civil penalty. So what was happening in the forms, so in Form ADV, Part 2, where they disclose this stuff, they would say something like, we may use mutual fund share classes that pay us more, even when share classes that pay us less are available of the same fund, right? So you got MFS Growth Fund, one share class that pays a 12b1 fee, one that doesn't. We pick the one that pays a 12b1 fee. But what they didn't say in their disclosure was, we will do this, or we always do this, or we would never dream of using the lower share class when the higher price share class is available. And so the SEC kind of got them on disclosure. So it's legal to do this, still legal to do this, but you got to tell people you're doing it. And so if you're not telling people you're doing it clearly, which the SEC determined really nobody was, almost exactly, I think it was 102 firms ended up kind of either coming forward or eventually being forced into the light. It was about $150 million in money being paid back to clients. That disclosure initiative was brilliant. One, the SEC didn't have to go after each individual firm, so it saved them a bunch of money. Two, waiving the civil penalties, let these firms look like good guys. Oh, we're coming forward and disclosing, look how great we are. We were screwing you for a long time and now we're not, but fine. And three, the thing that's most fascinating that I haven't fully completed but seems to be true in the ones I've looked at, the firms who were caught by that initiative seem to have stopped doing it. And so they were collecting 12b1 fees, 25 basis points. Again, $140 million, not small change across all of these. And probably more that, I don't know how far back they went. They were doing this. And now if you read their Form ADV Part 2, one, the disclosure is far more clear. And second, now that it's far more clear, they look like jerks for doing it. So they say they don't do it. So they say like, hey, you know what? We use the lowest possible share class that we can find. If we really love this fund and it doesn't have a share class without a 12b1, which exists for some firms, we will rebate it to you in your advisory fees. So if we were charging you 1%, we're going to charge you 75 basis points on that piece of your account and your whole. To me, that is a really good outcome. I mean, would I like 12b1 fees to sort of disappear? Sure, in a dream world. But again, in and of themselves serve a purpose in many ways. And so it's the approach, it's the use. For a long time, the SEC has been regulating sort of by disclosure, right? So the prior SEC chair would sort of say things like, hey, you know what? Disclose this, disclose that. Tell everyone about this, tell everyone about that. So we know, lots of data, no one reads disclosures. They're written in super confusing language. And by the time you get through them, you still don't really know what was happening. And so I think disclosing things is insufficient as a regulatory sort of reform. But this share class disclosure initiative actually kind of worked. And so we're seeing far fewer 12B1 fees in these accounts. They were already not very popular in retirement accounts, or so I thought, doing a separate project, brand new one on that. And turns out there are a lot of them floating around in there. Again, none of this is illegal. It's disclosed opaquely and in many cases poorly. And so that initiative really did change behavior. I would love to see the SEC come after revenue sharing. I don't know if that'll happen. But that's the next big sort of nasty conflict out there that is not, the SEC cares about it, but they haven't come after it in a systematic way.
Well, that seems simple enough. I hope that is something we can see come at some point or another. Something else that you had mentioned earlier was just with the affiliated mutual funds. Would it be possible to even get rid of those or to disallow their use?
Well, it's so complicated. So, I think affiliated mutual funds on average are, immediately you think, okay, I'm an advisor of affiliated funds. I'm using these funds, in my client's account. I clearly may not subject to the same due diligence. I find that in my paper. Maybe these funds aren't as good as other funds. And so I struggle with the affiliated funds in a couple ways. If they are affiliated funds that are very low cost and are index funds, I'm kind of fine with it, right? So Vanguard's not in my paper, by the way. I didn't really know how to include them. Their business they have an advisory business, but their mutual fund piece of their business is so much bigger that they didn't end up in my sample, nor did Fidelity. And those are really the two that have these great low cost index funds, that many of them are these very clean share classes that, if I'm an investment advisor and I want a mutual fund, I can find one that has incredibly low fees and isn't paying me a kickback. So to me, those are kind of fine. So if I'm a Vanguard advisor and I use a Vanguard index fund that's low cost, it's hard for me to argue with that as me as an academic, I don't see a huge conflict there. But, if I'm Vanguard and I'm using an actively managed fund, Vanguard, 1/3 of their funds are actively managed, and that fund maybe isn't as good. Again, how do we determine that, right? Very hard. I can look for persistence. I can look back over time. But again, we know that actively managed funds, on average, it's hard for them to outperform passive. And over the long run, they often don't. That doesn't mean active managers aren't talented and smart. It means they're charging fees up to and including their talented and smartness so that the net effect for the client is either zero or negative on average, right? And so affiliated funds is harder, but I think affiliated expensive active funds would be a little bit easier. And so I think you could come after that, to say something like, hey, here's the rule. If this fund, it costs, you can look it up in Morningstar. If the fees are above average, if the persistence is not there, if the performance is below average, then you could probably try to come up with some regulatory reform around that.
Thank you so much, Nicole, for those thoughts. And I really appreciate you diving into some of these pretty complicated issues. It's pretty wild that you've described a few times how long it's taken you to sort some of this out. And yet we expect the average person to sort it out. And, this is your profession to do this sort of research. Yeah. Just to kind of share a few more insights is really, you're a professor of finance and investments. I'm curious if there are any book recommendations you'd give to listeners or perhaps to those who you're teaching.
Yeah. So it's interesting. I'm kind of glad you asked because I had done a great sort of, request of my Twitter people. I love them all. And, I got lots of good recommendations. I had some books that I also liked. So I actually wrote a few down here because I was just thinking about them. So, Jack Bogle, huge fan, of course, he wrote a book called The Little Book of Common Sense. It's a great, accessible kind of starting point. There's also a more, I can't get away without talking about Thinking Fast and Slow by Daniel Kahneman. Anyone who's interested in sort of investor behavior and why investors behave the way they do, that's a great book, both for investments and otherwise. A much deeper dive that's more technical, but really great read is Random Walk Down Wall Street by Burt Malkiel, who I actually got to meet at a conference when I was just starting out, and he was just a lovely gentleman. He's been around, he wrote some of the seminal stuff. He's wonderful. And then just a shout out to a couple of my friends on Twitter. Nick Majuli has a new book out, and I'm completely forgetting the name, but you can look him up. It's wonderful.
Just keep
Just
buying.
keep buying.
I've also had a chance,
Thank
and
you.
I don't know when this episode's going to be coming out, but Nick is coming on the show,
good.
and I've had a chance to read that book as well.
Good.
It is very
yes,
good.
I'm most of the way through it, and it's great. And then my friend Brian Portnoy has a great book about investing called The Geometry of Wealth, and that also is just a very nice. I think as a beginner, it's useful because it helps you kind of set some parameters and think about what's important to you, not just in investing, but kind of in your life. But even more so as you kind of go through your life, you can adjust. And so those, I think, there are dozens of books, but I feel like those will get you a good starting point depending on where you want to dive in. And again, Little Book of Common Sense is a great place to start because it's little, right? So you can get rolling on that pretty quickly.
Those are all great recommendations. I've had the pleasure of reading them all myself. And I do like that you threw Geometry of Wealth there in at the end, because for the person who has read plenty about investments, I think you ought to sort of turn your attention to some of these issues that Brian Portnoy is covering in that. One final question for you, Nicole. What does it mean to you to be a long-term investor?
These are good questions. As I get older, the answer becomes more evident, right? But I think being a long-term investor is thinking about your investments and your money and your planning in a really holistic way. And so I'm a finance professor. I have spreadsheets going out morbidly until I die, right? So I think a lot about the long term. And I think also, again, so there's I want to plan kind of for the future, right? So the long-term investing isn't just, do I buy this fund or that fund, but it's really thinking about where am I right now? What are my needs? So if I'm a long-term investor, right, I'm thinking about the long term. You can see my kids in the background. They are 14 and 13. We'll be going to college soon. So some of my long-term plans involve making sure that they're financially stable. They can go to college. When they come out and they need a house, maybe I can help out with a down payment or a wedding or whatever. So long-term is not only in what do I pick, but kind of what are my goals. So if I think about that, my goals are college. My goals are for me to, I have a home. My goals are for me to make sure I can afford that home and maintain it and eventually sell it and maybe buy a smaller home. All those are parts of my long-term plan. My goal is at some point to retire. I don't know exactly when that is, but I have some ideas, right? So I think when you think about long-term investor, you have to sit down and go, even if you're 25, right? That's best time to do it. I'm here right now, and think about where you want to be. Once you kind of map that out, then the question is, well, how much do I need to save, right? And the answer is probably can never save too much, but you also don't want to miss out on fun things in your life. So you figure out that balance. How much do I need to save? How much do I need when I hit those goals? How much do I need for my kids' college? How much do I need when I retire? When I sell my house, how much am I going to get? Am I going to go buy another house for cat? All those things. You can think about that picture, that plan, and then you just sort of think about, okay, where am I putting my money? So the long-term idea is that I want to be able to, at some point, start drawing on that money. And some of it I draw sooner than later. So I'm investing my kids' college money. I'll certainly draw on that sooner than I will on my retirement money, right? I hope, or I think. And so, when that kind of happens, you think about, okay, then where do I put it, right? And I am very simple in my actual choices, right? I'm an indexer. I kind of like total stock market portfolios. I got a little bit of money in cash, a little bit of money in bonds. But another thing that I think a lot about is that the inadvertent investments you make. So I live in Massachusetts. I bought a house in 2004, sold it in 2010, bought another house. Real estate is now a much bigger percentage of my net worth than I expected it to be. Now, that's a good problem to have, right? Home price appreciation has been insane, but a lot of my net worth is actually tied up in my house just simply because the price has appreciated so much. So when I think of my long term, I can't ignore my house, right? I don't know exactly how to count it, but I can't ignore it, right? I have a big chunk of equity in that house. That may affect how I think about some of my decisions. If I bought a second house, how would I deal with that? Do I want to take a home equity loan when rates are low and use that for, stuff? And so, I didn't plan to have a big chunk of equity in my house. I never think of my house as an investment. I'm very it's a place to live, consumption. But it actually is one because I live in a place with expensive houses. And so I think a lot of your allocation can be very intentional and some of it just comes along and you have to kind of consider it.
That's so interesting. Thank you so much for sharing that. And one last question for you before we head our separate ways. Nicole, where can people find you?
Sure. So you can just search me out, Nicole Boyson, Northeastern, and you'll find my homepage, which is a useful place to start. Links to my research, my CV, if you're on the academic side of things. I'm on LinkedIn, again, Nicole Boyson, easy to find. And there I try to keep updated my current academic work. But where I really love to be is on Twitter, which is where I met you and dozens, probably hundreds now of my academic friends. I'm Nicole Boyson, and my handle is at Nikki R1, so at NIKI-R1. And you can find me there. I'm happy to interact and chat with folks about finance or some other interesting things I like to think about. Some of those things include, pictures of my cats, the occasional rabbit running through my yard. But, mostly I'm there to chat with my folks about finance. And I think it's really important for academics to be accessible. And you can't do it the first half of your career. You're too busy trying to get tenure, and your incentives aren't aligned. But now I have tenure, and I'm looking to be a little bit more broad-based. And so I think I hope I'm an example of an academic who is trying to bridge that gap between practice and academia.
Well, we all get to benefit from it. So thank you so much. And your Twitter handle emphasizes that your friends call you Nikki. I've been keeping it very formal here and calling you Nicole. And I actually meant to mention at the top of the episode that I may be starting to cut some little extras that come after the disclosures of the episode for all of you listening. So be sure to tune in, and you can hear a little bit about Nikki and my breakfast preferences. But thank you again for joining me. For all of you listening, you can find show notes and resources at thelongterminvestor.com. And until next time, to long-term investing.